made some progress here so far, kind of moving at a pretty good clip. A couple of things that are going on, looking at the syllabus and our timing on that. So, we've already started up on chapter 4. By the time of the exam, we're only really supposed to get through chapters 4 and 5 by the time of the exam, which is probably good that we're moving at a good clip. That way, we get to consolidate our efforts here as we get to the end and get ready for the test, so we can have a little time to get some practice in heading into that exam. So looks like we are, we're moving at a pretty good clip there. So what I'm going to do today then is we'll go ahead and finish off chapter 4, and then after chapter 4 I'm going to backtrack a little bit, and I want to do a review of time value of money tools. Okay, I think it's it's really important for us to make sure that you guys really have that down, because I'd say that's one of the defining features that differentiates you as a finance degree holder from other majors out there is a deep understanding of the time value of money tools, right? And so that's why I want to make sure that we do backtrack a bit and do a review with that. So we started up with the bond valuation. And so on the bond valuation work, then we already went through and did some calculations here with with some of the more simple things with the bond values, using the financial calculator to do really the bulk of the work for us, right? And that's what we've done so far here with the bonds, and just getting ourselves familiarized once again with the structure of a bond and how they work. So, next thing I'd say is you should get your financial calculators, your calculators handy, because we're gonna, we'll be working through these, and this is a great time to get practice on it and get familiar with it. How many of you are going to be using something like a TI 83 or 84? So a couple of you. If you have any troubles, because I present this primarily with a setup more from the BA2 Plus, setup, but if you have any questions, just stop me and I can support you on this machine also, right? So I've worked with, there are about 4 or 5 different calculators out there that I've had to work with and become familiar with and working with students over the years. So we know that we can get the value on these bonds. We don't want it just to be a black box though, right? And so we saw how we can break out those payment streams on the financial calculator and get it whereby we can look at the value of the payments coming back or that annuity, and we can separate it out and we can look at it in terms of the value of the principal amount or the face value, the $1,000 coming back on that also, right? And so these are the numbers that we got then as we hit the financial calculator. We put these in. In particular, if you have a 0 in here instead of the 1,000, and you'll kick that back, and it'll come and it'll give you $614.46 for the value of that coupon payment or the stream of coupon payments. Then you put in the 0 for payment and put the 1,000 back in for the future value. That'll give you the $385.54. As a black box though, this financial calculator can take both of those and put it all together here, and it comes back to that value of 1,000. Key things we need to remember then is if the coupon rate and the investor's required return are the same, right? If those rates are the same, that's going to be our price, right? Now, one way to think about that then is we'll just take this example right here. And let's say we've got 1, 2, 3, 4, 5, 6, 7, 8, 9. We've got 10 $100 payments. and then we've got our $1,000 face value. One way to think of that would be, well, if you're paying $1,000 for that, and you want to find out what your rates of return are going to be from this, well, from the current yield, as we define that, current yield being, sorry folks, so anyways, as we look at the notes coming up a little bit later on, you know, we're told that we have this idea of something we can call a current yield, and that is the annual coupon that's paid divided by the price. So the annual coupon payment divided by the price. In this case, that would tell us that the amount of return that we're getting out of the coupons there, right, is the $100 per year divided by the $1,000 price, or 10%. At the point whereby your required return is 10%, right, if that's what you want to get out of it, then you are receiving your 10% required return that you want out of it just out of those coupon payments. You're willing to pay exactly $1,000 for that because you put in your $1,000 and you recover exactly $1,000 at the end. In this case, it's pretty obvious that the capital gain yield capital gain yield, or that return associated with the change in the price, right? You pay $1,000 for it, but you get $1,000 back at the end. Well, that's just a big fat zero, right? Okay? And so we kind of you know, work off that central tendency, or that central point whereby the coupon rate and the yield to maturity / required return are the same, right? And then everything works off of that. As interest rates go higher, price comes down, right? As interest rates go down, the price moves up. And then we've just got these examples that exhibit that for us, right? All right. So that's a bit of a review then, what we looked at last class. Then this graph just shows that over time, the clean price, as we call it, of the bond is going to move towards the $1,000 maturity value, right? So just think that you're going to pay for that bond. You're looking to buy it shortly before it's going to mature. You're going to get that $1,000 face value back on it. Now, that's why we have to refer to it as the clean price, because when you buy that bond, and say you get it just a couple of days before maturity, we also would be receiving that last coupon payment there. But you have to pay for that accrued interest payment also, right? You pay that, but you can kind of pay that in a separate fashion from the clean value that you pay. All right, and so that's a potential bit of confusion there. So you just keep in mind that that price is going to be moving towards $1,000, and that keeps you pretty well centered up on that. Okay, so in this case, we can see if the cost of debt or the required return doesn't change, then the price is going to stay right at $1,000 the whole time. So I generally like to post up then a big table then to reflect what's going to go on here. So we've got our coupon rate stated as an annual item, right? Annual rate. When it is equal to our yield to maturity, or the cost of debt. Then our price, in that case, is right at $1,000. We say that that's at par. If we receive more out of the coupons, right, whereby the coupon rate is above our required return, then our price is going to be at a premium of above $1,000, right? You're getting more from the coupons than what you're requiring on it. And then finally, if your coupon rate is below your required return or your yield to maturity on that, then you're going to have to pay less than $1,000 in order to get the return that you require, right? You got to pay a lower price in order to increase your return potential out of it. All right, and so a little, definition around the yield to maturity. We just want to understand that that's generally the return that we look at, right? Is that yield to maturity? That's what's stated out. But it's assuming that you buy it and you hold it all the way till that bond matures, and that's a critical part of that. It assumes, of course, that you do not have a default happening on this. And then when we talk about our yield to maturity, we want to keep in mind that that reflects the fact that we have to find that discount rate that takes those future cash flows and makes them equal to the price that you're paying. And so it turns out the calculator has to iterate, has to search around to find that. But it uses the sort of information that we put together, well, just like this, right? That the changing interest rate will push the price up or down in an inverse fashion until it hones in upon that discounting of these cash flows that gives you the actual market price. And that's how it seeks that out and finds it. All right, so we went through some examples here. Let's go ahead and hit this one. Just get the financial calculators fired up a little bit here. Let's say that the price on this bond is $1134.20. Remember, for financial calculator purposes or timeline purposes, you would think of that as a negative, right? Because that's a cash outflow from your perspective, right? You'd be paying for that, right? So you put down the minus $1134.20 as the PV. 9% coupon rate on this, giving you $90 payments, 1,000 face value, 10 for M. Couple of things then that we know before we hit the financial calculator. All right? Price is at a premium, right? It's above 1,000. Price is above 1,000. So that tells us something about the relationship between the coupon rate and the yield. In this case, the coupon rate is 9%. In that case, we are getting more out of the coupon payments than our required return, right? We're willing to pay more than $1,000 for that, okay? And so when that's the case, that means that our yield is going to be less than the coupon rate there. So you've got yourself a checkpoint, right? You can always assess these logically in addition to hitting the calculator to get a number out of it, right? Oftentimes, boy, professor can really make your life a lot easier if you're keeping on top of these things by maybe only giving you, several multiple choice responses that are logically not even reasonable, right? And the last one is the only one that would meet the standard of a reasonable answer. You may not even have to hit the calculator sometimes, right? That's a whole lot better than relying on the calculator all the time without knowing what we're doing, right? Because once you start doing that, we have people making bad decisions on bad results, right? And so we want to make sure that we understand what's going on here in addition to crunching numbers. Okay? All right, so we had our current yield and our capital gain yield, and we showed them last class in terms of the original example that we had there with the 10.91% yield to maturity, that since the current yield on that 90 over the $887 price comes in right here. It's the difference between that current yield and the yield to maturity that is coming to us from the annualized capital gains yield. This capital gain yield is going to be positive because, right, the current price is $887, and the end of the timeline, we're going to get $1,000 back on that. Right, so that capital gain, that change is positive. In some cases, you'll have a negative number for that capital gain yield. right? If we just go back to this example here, right, we would have a negative for the capital gain yield. So let's see here. If we've got the 7.08% there, go ahead and help me with this one then, right? We know that the yield to maturity equals our current yield plus that capital gain yield. So my question to you then is, what is the capital gain yield then in this particular example then? And just shoot your hand up when you think you got that number for us then. Okay, Kieran? Hold on, let's give everybody else just another minute here to try to piece that together. So before we crunch the number and complete here, right? First thing is our capital gain yield going to be positive or negative in this case?
Negative.
It can be negative, right? Because you're paying more than $1,000 for that. Now, if we look at that, we would say, what, 1134.20. In total, it's about 13.42%. That is going to be dropping over the whole time frame, right? Everybody on top of that? But the rate that we have to have for this calculation here needs to be annualized for us. So we just back that out from the information we have. So Kieran, what have we got for this one?
I got negative 0.855%.
Okay, I think you got it right. So of course this would just be, we'll just take the yield to maturity as they give it to us here with whatever rounding there is, right? There's probably a little bit of rounding going on. Your current yield then is the annual dividend divided by the current price, and then whatever is left for you then is your capital gain yield. Okay? And so the current yield, 90 over 1134.20, 0.07935. (7.935%). We'll do it like that. Looks like that, and then we just take the 7.08 less the 7.935 there, and it looks like it's about minus 0.855%. So remember once again that you got your logic checks that keep you out of trouble on this, and put those to use, and then remember that this is an annualized rate, so the easiest way for us to tackle that is just to do it straight up through the backing it out from the yield to maturity that you've calculated there. Now, there will be some questions for you that will look for you to do it in a different fashion, okay? Let's just go ahead and do that then, all right? So, I'm doing this on the fly here, so it'll take me a minute to make sure I don't mess anything up, right? But let's go ahead and look at this example then right here. Okay? With the 9% coupon, 10-year bond. And so our original setup on that is we would be willing to pay $887 for this bond that's going to give us $90 10 times, right? Like that, okay? And from that, it is established then that our yield to maturity is 10.91%, and the current yield is 10.15% there, right? And so from that, we also then can back out that the capital gain yield is 0.76%. So let's look at doing it more mechanically then, right? What will we get out of this? Well, the main thing that we need to look at then is to identify that the capital gain yield could be calculated out over 1 year movement in the price of the bond there. Okay, so we could do it off of just 1 year's price movement there. So instead of going with this at the price of 887 there then, right, we would need to find what was going to happen to this price and how it's going to change. And I'll just say that we're going from year 0 to year 1, right? What's going to happen to the price in that case? So our inputs into that now become, well, we're looking to find the PV. We have the same yield to maturity there. We've got the same payment. We've got the same future value of 1,000. But the number of periods then for this discounting has now moved down to 9 years. Okay, so now we're just taking, we want to see what the actual change in the price is going to be on that particular bond. So now we put this all together, and we're going to find at year 1 what we expect the price to be based on these parameters. 10.91 for the yield, 90 payment, 1,000 face or future value, 9 for N, and we compute out what we think the price is going to be here. It's going to be a little bit higher, right? It's going to be a little bit higher than the 887 because those prices have to move towards $1,000, right? So it's going to be moving up towards $1,000. The price now is sitting at $893.87. So now let's take a look and see what happened in total with our capital gain over that 1 year, right? What was our percentage change in the price of that bond? Right? So the percentage change will look like this. 893.87 minus 887 over 887. And we get, it comes about 7.7 some odd percent there, right? And so it just has to do with a little rounding on, decimal places and everything within there. So it comes back and it shows us then over 1 year that the percentage change in the bond price is consistent with what we have to say that we get it by backing it out using the yield to maturity and the current yield there. And that's what they got right there, right? That's what they tell us to do. All right, so most of the bonds that we work with, they're going to be semi-annual. So a lot of the work that we've done here is gets a little bit more complicated because we have to deal with the fact that the payments are happening twice a year. We come up with semi-annual rates and then have to annualize them, right? So we'll be oftentimes having to deal with that. So the inputs on the financial calculator are pretty straight for us. The number of periods, like we have a 10-year bond, would now be a 20-period bond. The annual yield, let's say 11%, would be 5.5% per 6-month period. The payments per year, right, let's say $90 per year are going to become $45 every 6 months, and those are the adjustments that we need to make with our financial calculator, right? So let's just go ahead and get a little practice in on a 10-year bond with a 10% coupon and how that would look. The main thing that you would want to note then, right, you'll be told something like, oh, you got a 10-year bond, how are these things going to work out, right? Well, first of all, and it's going to be 20, right? You've got to double that up. Your payments here, 10% coupon, 10% of the 1,000 face value, that needs to get cut in half, and that's where you then get the $50 every 6 months that you're going to be receiving as your coupon payments out of that. Face value stays the same. Payment and then your required return that you work off of in this case, right? You take whatever is given to you, in this case 13% per year, and it just gets cut in half to give you 6.5% every 6-month period. So essentially, 9, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay. So you start out with 10 years. Essentially, all you're doing now is you're making your focus on twice as many periods that are half as long, right? So you're just taking that twice as many periods that are each now half a year. So this is the information then that you pop into the financial calculator. You should be able to kick back then $834.72 as the price on that bond. It's going to be a little bit different from what you had on the 13% with the annual. In fact, the price should be just a little bit higher, right? The reason to be just a little bit higher is because instead of getting $100 at the end of each year, right, you're going to be getting half of it half a year earlier every time, right? So in terms of time value money, that increases its value to you just a little bit. Right? You get it back in a little bit sooner. All right. I don't think today we'll do this. I think Monday we'll come back. We'll start working with some of the spreadsheet functions on these things and take a look at that. All right. Any questions on the valuation on the semi-annual bonds there? Oh, the other thing, of course, then is let's say we take this and we're working off of it. If you are asked in this case, right? Let's just take these exact same numbers here, and let's say that you get the PV of right minus 834.72. Okay, so you got that, and this is all the information. Let me get my financial calculator fired up. Have you got a financial calculator?
Yeah.
Which one is that?
VA2+.
Oh, that's the new fancy looking one. Okay, good. Totally different graphics from this old one here, right? Okay, so let's go ahead and set that up. We got 20 for N, 1,000 face value, 50 for payment, 6.5 for I, compute, PV. So we got the 834.72. Okay, so now let's say if this bond actually had a higher price, let's just go ahead and throw one out there. PV of $909. Right? Put that in. First of all, before you hit the calculator, what's going to happen to your yield to maturity on this? Higher price. What should be the relationship with the interest rates on that? lower yield, right? You pay a higher price for the same set of cash flows, your return you're going to get out of that is lower. Okay? So we put in the 909 as the PV here. Can someone tell me then what is your yield to maturity on this one? Which one? You got it? Are you following along here with the calculations? You're not? Okay, well then we need to work on that, yes.
The, 5.78%.
5.78%? I don't think so. It might be on the right track. Hold on. You might have the numbers all in there, right? But what is the adjustment maybe that needs to be made there? Yeah, you got the right baseline number, but there's one thing that you need to keep in mind. You calculated that based off of 20 semi-annual payments, $50 semi-annual payments, right? That's the size of them. So you calculated out the semi-annual yield to maturity. What do you need to do with that now to turn it into your annualized yield?
Times it by 2.
Double it up, right? So he had it all in there, right? I came back as 5.779%, right? From that information right there, that tells us then that we need to double that up, and we come up with a yield to maturity then of 11.56%, right? So it is lower than the 13% annual yield to maturity that we had before. Okay? All right. That's our quick review on the bonds moving to semi-annual there. Right? If any of you having trouble getting these numbers to kick out, we'll take time during the break or after class and sit down with you and crunch some numbers out on your calculator to make sure that we've got these things humming. Okay? All right, so let's also then remember then we have the issue of callable bonds. Right now, with interest rates at historically low levels, companies, there's not a whole lot of advantage for them to be issuing callable bonds, right? In fact, if you're an investor and some company is issuing a callable bond, you're kind of going to ask the question, well, what's going on here? Why are you doing that, right? Because the likelihood that interest rates are going to fall enough for the call to become valuable is very unlikely. Right? There's just not a whole lot of need for callable bonds to be getting issued right now. A lot of the callable bonds that were out there the last, from about 10 years ago, they've all been called back and companies have refinanced essentially, basically all of those old callable bonds. Right? So there's not a whole lot of them sitting around right now. So let's say we got a 10-year, 10% semi-annual bond, $1,000 par value, sells for $1135.90. And an 8% yield to maturity. So it has a deferred call feature, so it's got protection from call for the investor for 5 years. Okay, so we look at this right there. It's a 10-year. Semi-annual, however, right? So it makes it 20 periods. Boom, 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 right? So each of these are now kind of doubled up there, right? Splitting them in half, doubling up the number of periods here. It can be called after 5 years, right? So at 5 years, it implies n equals 10. Right there, we have a call price of $1,050 right there. That's in contrast to, right, the usual face value that you have of $1,000 on that bond, right? Right. So that's generally what we'd see if it were held all the way to maturity, right? Would be the $1,000 face value. So let's go ahead and start working on this, right? What is our our coupon payments on this. How much per payment? 5% equals what in dollar terms? The $50, right? Keeping that in dollar terms because you don't want to make the mistake of slapping it in as I, and then get yourself off track, right? That's $50 there, okay? 8% yield to maturity would say that, I'll just put it in as yield of 8%. If we were to value this out over the full 20 years, what would we use for the I on this? 4%, right? That's where you cut it in half then, okay? All right, so let's see what they're gonna be asking us here then, right? Let's find that yield to call, right? So one thing that we tend to focus on then is going to be, right, what is the yield that an investor would receive on this callable bond, assuming that it's going to get called, okay? The yield to first call is actually the appropriate name for this, right? So you always calculate out the yield to call based on the first date that it could potentially be called back. And this would be after 5 years or 10 periods. So from an investor's perspective, right, that investor would be expecting to receive 10 payments, right, 2 per year over the 5 years, $50. Face or future on that one? Not really face. Now the future value on that timeline, what would we have in for that one? For the callable, and assuming it's called.
Oh, 1050.
The 1,050, right? You got the $50 call premium in there, right? Okay. And let me see if I got any other information. NPV. We're trying to find the yield to call. What's our price on that baby at $1135.90? Right. So that's how all that information comes together for you, right? So we got that call price of $1,050. We got the payments going on here, and the original price was $1135.90. Okay. So let's kick that out. $1135.90. PV. 50 payment, 1,050 future, 10 for the number of periods, 50 for the payment, compute out I, right? That's the I that you get back, that's your semi-annual yield to call. Double it up, and that gives you your stated yield to call on that then. there.
Just to be,
Uh-huh.
can you go back to the last slide?
Sure. Right there.
Okay.
So one of the things on this also is keep in mind, with the information that was given to you here, it could have been done without giving you the price on that originally. And you should have been able to work this out all the way too. Right? Because it gave you enough information based on the yield to maturity there that you could back out that price of $1135.90. Right? You've got payment of 50, you've got N of 20, you've got 4% yield per 6 months, right? So your I would be 4% on that, and then you could use that information to come back with and find that price of $1135.90 there. Okay? And then you would be off to the races for your yield to call calculation. Yes?
So to find the yield to call, we use N equals 10 because the call price was at 5 years.
That's right. So it's callable. It's got a deferred call, as we refer to it. So there's protection for the investor that it won't get called on them for 5 years at least. Okay? And then oftentimes we'll refer to the yield to call as actually the yield to first call, or the yield to the date of first call, because that's where you always calculate it out to, is you look at when the first time it could possibly be called back on you. Any other questions? All right, and then we come up with that nominal yield to call then out of that. Then the next question is, well, if you buy these bonds, are you more likely to get the yield to maturity or the yield to call here, right? So what we see out of this then is they got a coupon rate of 10% there, and it says that based on this, we see that our yield is about 7.53% here. So in this case, they should expect that call to happen, right, from the company's perspective. Really, look at this, you know, we work at it versus the 8% then, really. And so the 7.53% indicates then that the issuing company would go ahead and pay off those bonds at the call price, right? Because that's cooked into it, right? That 1,050 is cooked into that 7.53% yield to call there, and they would go ahead and buy those back. And once they buy those back, they would, using the call provision, then they could raise some more capital at the lower 7.53%. Okay, so that's what investors would be expecting at this point, is that it would be getting called out of that. So their returns on this bond, and that they should be expecting, should be the 7.53%, not that yield to maturity of the 8%. Okay, so bond investors who hold callable bonds are sitting there all the time juggling that, right? They're calculating out both the yield to maturity and the yield to call, and then they're having to assess that and figure out, based on the information given, which one should they be expecting to get at that time, right? So one way to think about it here is that interest rates have fallen, right, from the 8% down to the, from the 10% originally down to the 7.53% there. Right, since those interest rates have fallen, then the likelihood of a call is very high as that price has come, as the rates have come down. So in general, we put it that way, if the bond sells at a premium, the coupon is greater than the cost of debt, so the call is likely. One thing that we see though is, since investors know that it's got a call price of $1,050, and we got that premium on that, right? That's going to be after 5 years. The price sometimes then gets held down, right? That 1135.90, which we're seeing in this example, may not be the real market price on this, right? Because it kind of gets capped, not exactly at the call price, but there become pressures out there. Investors look around and say, hey, this thing's going to get called, well, and it's going to get called at $1,050. Well, there's no need to be paying a whole lot above $1,050 on that. So those call provisions then kind of cap the rise in the price on those bonds, right? It kind of makes it so that they aren't able to shoot up that much before the call date there, right? We know that it can, right? Yeah, I mean, it can go up to 1135.90. We got all the way to 20 years, but then investors start looking at, wow, they're going to buy it back from me at $1,050 in 5 years. Then maybe the price I should be willing to pay shouldn't be going up quite so high anymore. Okay? So then the market starts doing its work, right? I mean, essentially, there's all these adjustments going on in that. So on premium bonds, you expect to get that yield to call. On the discount and bonds at par, generally you'll get your yield to maturity out of those. Let me check my notes, see if there's anything I should have been talking about here. Got that. All right, so let's kind of back out a little bit here then and make sure we have an understanding of the components that come together to give us our required returns. And in this case, we're talking about the required returns on the debt in particular. We start from a real risk-free rate of return. In practice, when we talk about real rates, we generally get those by looking at the interest rates out there in the marketplace, or the rates of return, and then we subtract out the inflation that occurred over that time frame. Everybody recall that idea, right? We say, well, the focus here on a real risk-free rate is, do you keep your purchasing power up, right? Do you stay ahead of rising interest rates? I'm sorry, rising inflation rates, right? That's really what the focus is here with the real risk-free rate. Now, one way I like to view it then is the real risk-free rate represents the baseline return you deserve for taking your money and not spending it. Okay? You deserve something for taking your funds, providing them to everybody else then to engage and put to use. And that's where that real risk-free rate comes to you from, right? That's why you deserve to get that, okay? On top of that, of course, we want our investments to keep up with inflation, so there's the inflation premium. If something is higher risk of default, we're going to expect a higher return for that. If it's difficult to sell quickly at a good price, we're going to want to pay less for it to push up our premium on that, right? It'll give us a higher potential return for things that are less liquid. And then finally, there's a risk premium according to maturity. And we'll talk about that here in greater detail. So these are the main items that come together that influence and give us that required return that we have when we make this investment in debt, right? If as an investor that's what we require, then the company is going to have to provide that to us, and that's why it becomes their cost of that financing, right? If that's what we require as an investor, then from their perspective, that's the rate of return they have to provide to us. That's how it then becomes our cost of debt, right? So from the investor's perspective, it's our required return. That's what we want for the risk of that investment. From the company's perspective, then to provide that return to us, it's going to be their cost and one of their components of the weighted average cost of capital. All right, so what is our nominal risk-free rate? So nominal means what's stated out there, what you can see, right? That's what's posted up for everybody to see right now are these risk-free rates. And so the two components that come together for that are the real risk-free rate and the inflation premium. In most cases, we can just add those two things together, okay? Interest rates are really low right now. They have been for quite some time. What does that reflect then about expectations about the economy? What do you think that tells us people have felt about growth in the economy or that number there? People excited? They think that the economy's going to rock and roll? Of course not, right? So even though we could argue that the central banks around the planet are working very hard to keep interest rates low and putting all of their resources to use in that regard, there are other market reasons that the interest rates are still low also, and it's just folks don't have that great a confidence, right, of the economy picking up and inflation coming into play because of a robust economy. All right? All right, so that's really the key ingredient there. Generally, we can just add those together, particularly in this period where inflation rates are low, then there's no worrying about the cross-product term there, I would say. Does that make sense? The cross-product term doesn't matter much when we got really low rates there for the inflation premium and for the real risk rate. So we can just add those guys together, and that's generally going to get us to our real, not to our real risk rate, but get us to our risk-free rate. Generally, we have on Treasury securities there. So there are a few different ways that we can estimate out our inflation premium that's built into this. And any of you familiar with things we call TIPS then? Treasury Inflation Protected Securities, right? Yeah, I'm holding those, right? I've got those in my personal portfolio. And my argument is this, okay? Of course, I just want to be protected if inflation really does kick into gear, because all the tools that are getting used to keep the economy going right now are things that could encourage a lot of inflation coming up in the future, right? I mean, it's just, we call it all easy money policies, right? It's got potential that if we hit a turning point, the economy does pick up, then we'll have really, really high inflation, right? Which can be painful for, particularly for the working class, right? But the other reason, though, that I have myself in the Treasury inflation protected securities is this. Your training that you're getting on portfolio management, on the capital asset pricing model and the like, right? Those are all built using a nominal risk-free rate as the baseline return, right? Well, that's one way to look at the world, right? But if we think about the fact that what we want is not just to keep up with a risk-free rate of return, but we want to maintain our purchasing power, right? That we want to have things that will go up in value as prices, right, of consumption goods go up, then we might be better off building our portfolios based off of a real risk-free rate. Okay? And then that's where, when you have a inflation-protected security in there serving as your risk-free investments, they are really risk-free. Right? They are inflation-protected also, right? So they have that protection also, so it's truly a risk-free foundation then to your investments. Okay? So just throwing that out, would like you to think about that as you go on into the asset management, wealth management world, and you're working with your clients, right? That you might say, you know, maybe instead of just buying treasuries that are paying 1%, let's buy tips that pay maybe about the same, but they're going to go up for you if inflation kicks into gear, right? And so that's one way to think about that. So anyways, we can look at the tips, the yield on those, and the difference on those versus what we have on the treasuries, and that gives us an estimate of the inflation premium out there. All right, so a bond spread then is the difference between the corporate bond yield and the treasury security yield, right? So essentially, let's just say that we take a yield on on a corporate 10-year bond, maybe bond index, just to maybe make it more broad, right? And you just subtract out of that then the yield on government 10-year. So the main thing here is when we talk about the spread or the risk spread on this, we want to do them where they have the same maturity, so you get rid of the maturity risk premium out of there, right? So we're just focusing on things that have the same lifespan to them, and then what's left out of this then is just going to be your default risk premium and the liquidity premium, right? Because the other components that you got here, well, it's just what do we have here? Let's put them all together. We can see. Okay? And so that's essentially what's going on here, right? When we look at the yield on a corporate 10-year versus the yield on a government 10-year, they've got the same maturity risk premium, right? Those cancel out, right? The baseline short-term risk-free rate, right? That's the same, so that'd be our treasury bill rate right there. And so all that's left for us then for that spread is going to be the default risk premium on that corporate bond plus its liquidity premium, right? Because those items are inconsequential for a government security, right? No default risk premium for a U.S. government bond, right? And no liquidity premium either on that. They're very easy to trade, right? Very easy to move in and out of those treasury securities there. So big companies, really small liquidity premiums. For small companies, they can be up to 2%. Very recently, you know, in the current market environment, there were some times where the spread between the corporates and the government, particularly about the 5-7 year range, almost nothing, right? This spread, right, the default risk premium and the liquidity premium for the corporates versus what we had for the government bonds was almost non-existent, right? There was hardly anything there. Okay. And so, pretty recently then, we've got some numbers we can look at. So we've got these bonds with their different ratings on those, investment grade versus the junk bonds. Investment grade is important because a lot of like university, foundation funds, pension funds and the like are restricted. They cannot invest in any junk bonds. They can only invest in bonds that are BBB rated or higher, generally is what it is referred to as, right? So BBB or higher. If we take a look, we can see the default rates on these, right? That it looks like they're pointing in the right direction. They have a pretty good idea. We can see that there are higher default rates for the lower rated bonds, right? And even within the investment grade bonds, as we call these, right? The investment grade bonds here, that we have difference in the default rates there as we go down in grade a little bit. So looks like Fitch has done okay with that, right? We want to take a look at the spreads then at the 10-year horizon then, and so we want to see these different bonds, and we can see here at 10 years it was about 0.6%, right? So that takes care of both the default risk and the liquidity risk, the premiums in that, right? So you were getting hardly any extra return from taking the risk of investing in corporate bonds versus treasury bonds, at least in the AAA realm there. Now, once you kicked it out to a little bit additional risk, right in that range, you can see that's probably the biggest jump in the amount of return you get for the amount of risk that you're taking on. And then, I mean, it goes up, you get higher returns from the junkier bonds down here, but you can see that, you know, you're gonna be taking on quite a bit of risk. CCC, which is things that are considered to have a good likelihood of going into default, right? Maybe 25% chance of defaulting on you to get a 9% rate of return, right? Is it worth it? You know, depends on the investor, right? It all depends on the investor. Personally, wherever I got some money for bonds, I don't hold hardly any bonds because the rates are so low, right? I've been holding emerging market bonds. And that's where I've had my money because they've been delivering about a consistent 11% per year, despite the ups and the downs out there in the marketplace, right? So I've been pretty happy with, you know, hitting that about 11% return. Last year they took a huge hit, the emerging market bonds did, but they recovered nicely once again here in about the past 5 months. So it's really tough investing though for people who want to go with low risk investing, because if you want to go after bonds, there's not a whole lot of return that's available to you, right? If we take these as examples, you want to go with low risk treasury, or you say, oh, I'll take some risk, I'm going to go in high quality corporate bond, you're still only getting up to about 4.5% maybe at the most that you can get out of those. That's pretty tough rates of return to build a future portfolio off of, right? So it's a tough investment environment for folks who want to go with low risk. Now, if you're willing to take on some risk and you've had your money in the stock market the whole time, you're a happy camper, right? Things are fine, right? But not everybody is able to do so, right? They're not able to take that risk. All right, so when we look at the default risk and the bond ratings, they go through these things, the ratios, debt ratios, coverage ratios, profitability, etc. So we'll be looking at our ratio analysis again in this class a little bit later on. Many of you will go into your first jobs will be associated with credit analysis, okay? And you may do it for small businesses, for those types of loans that a community bank or local bank may be giving out. That's an area where they need people who know how to take these financial statements apart and do that analysis. Or if you're at a bigger bank, you might do the same thing, or you go to the level of working. We've had some graduates of ours went to work for Fitch Ratings a while back, and so that was his job, tearing apart the financial statements to get an idea of the risk of these different companies, right? So it's real important to see the need for those skills in that finance arena, right? The accounting skills too really matter over there. So the bond ratings then, we want to take a look at the different ratios on these. Right? The AAA have better interest coverage, right? Higher return on investment, right? Return on capital invested, and lower debt ratios also. Kind of like all things we expect to see, right? So that's consistent then with what the rating agencies do with these. Right? Take a look down here. Right? This is where you're probably getting to a telltale sign, right, for these triple C junk bonds there, right, is that, and the these are junk also, but you start getting down there and you can see that they've got more debt than they have in equity there, so debt equities are way too high. All right, other factors that affect the bond ratings then, actually, it's not a company that gets a rating. It is a particular bond that gets a rating. Of course, it's pretty easy to adjust it once they have it for one bond of that company, and then they can make the adjustments for each individual bond, right? But you think about it, right? What are the provisions within that bond that can influence its rating there, right? We want to look at companies that have more stable earnings. Are they facing regulation changes that could hurt them, potential product liability? If they're not good on their accounting, right? If they aren't giving out the reports on time, there's any delay in that, man, that's a big red flag goes up right there, right? And we see that a lot of times, particularly with mid to smaller firms. Sometimes when a big company does that, boy, there is some panic associated with that company there. All right, let me see how many slides we got here. Yeah, so let's take ourselves a little breather here then, and get a drink of water. We'll come back and about 10 minutes and start up and knock out this chapter, and then we'll start doing a bunch of time value of money things so you guys get a lot of practice then working that up there. these doctors, man, I keep injuring myself, but I don't break bones, right? And don't tear the ligaments, right? So I had a couple of cortisone shots last year for swelling and the like. So they want to run blood work. And they say, oh, maybe you have gout. I'm like, I wouldn't have gout. I exercise. I don't have gout. And then maybe you have Lyme disease. Like, okay. And so they took my blood a week and a half ago, and I keep calling them, what are the results? What are the results? Finally they say, well, we checked your blood work. There's nothing wrong with you. You must just be overdoing it when you exercise. Like, okay, that's what that's what I told you. But it hurts a lot. So that's right, better than not exercising. So what can I do for you? Uh-huh. No, they're supposed to all be online, so even the ones that, in the last couple of days, I mean, I don't have the tools to do it, but the technology folks are working on getting those all posted up, so. I think they're committed to getting this all straightened out here in the next day. Yeah. Yeah. Sean, how were you doing on the calculations? You were saying that you were having a little trouble with the bond valuation stuff there? You need some ink? Okay, so, were you able to get the numbers though on the examples that we were doing in class?
Yeah, I understand.
Oh, you got the,
Yeah. And just need more practice.
okay. Okay, there are a couple things that I'll be doing a little later on here, but let me see a couple of settings here on your calculator, okay? Okay, good, so you got all those showing, and then, all right,
You gonna keep it there?
that should work, and then,
No idea. I was thinking about it.
$87.
Yeah, I got you.
Okay, that's good, yeah, it looks like it's working, okay, excellent.
Actually, I have a question about other class homework.
Mm-hmm.
We just need
Yeah,
some
that's
sensitive
okay.
information data.
It's just.
Yeah, well, I want you to come to me with the name of the companies you're interested in. That's all I need right now. Then by Monday, I'll come back and say, go with these companies. Okay, so which sector do you have? You have consumer cyclical, okay. So within that are a lot of, really interesting companies, right? So you see names of companies that you think you'd be interested in looking at, that's the main thing.
Where were you trying to be?
So right,
No, not yet. You will, but not now. Over the semester.
supplies on information.
Yeah, just look at them enough to know that you are, those are the ones you want to work on. Okay, and they're in our list also.
So quick, I can
Okay.
get
In that spreadsheet. Okay.
Thank you.
We just like randomly decided to go back down like 2 days ago. For the 4th. Just we decided to come up, so. What's up? Really? Yeah, well, I mean, there's supposed to be like, the Outer Banks are supposed to be like slammed tonight. Yeah, tonight or tomorrow.
Yeah, I was supposed to go to Charleston for the 4th, and
Yeah.
we passed on it, and
Yeah, it'll be a wet one. Can't remember last time it was. Can't remember what it was. live in North Carolina, don't you?
Right now, yeah. You just moved to North Carolina, Virginia?
Somewhere in there.
Must be, 'cause I'm from this before, so.
Sure you live. Sure you live. Yeah.
All right, good deal. So, welcome back here. We're gonna go through a few other items here on the bonds and then look to, then turn over and look at some time value money work, just to give us some hands-on repetition. We'll practice on that. And so with the bonds here, we want to get a feel for the interest rate risk. So we talked about the different risk premiums that we have, right? And so in this regard, for a treasury security, right? Yield on a government bond, let's say it's a 10-year. We're going to have these different components in here that we are concerned with. Real risk-free rate, inflation premium, maturity risk premium. For the government bond, we generally treat those as inconsequential, right? The default risk and the liquidity premium. In some cases, so this is just an issue of academics and the like, sometimes people refer to the maturity risk premium and the liquidity premium together, right? They treat those kind of as one thing, right? But our focus here is going to be on what we call the interest rate risk, the risk that the price of a bond is going to come down as interest rates go up. That's something we've already established, right? We're on top of that. So now we just want to get a feel for how does it differ, right? How does it differ between a 1-year security, maybe a 1-year bond, and a 10-year bond? That's the important point that we would want to look at here. So let's go ahead and take this here, and let's just try to crunch out some of these numbers here just for a bit of practice, right? So in this example right here, right, if we know that we got a 10% required return, and we've got a 10% coupon on that, then the price of that bond is going to be $1,000. Let's simplify that, right? Let's make sure we know what we're talking about. All we'd be talking about there is 1 year, right? We've got a bond paying $100, and we identify from that that the price would be $1,000. In doing this manually, all we've got to say is this. We would be finding, so in a sense we're trying to find the price in each of these cases under those different rates, right? We're just saying that the present value of $1,100 discounted for 1 year at 10%, well, you can do that very quickly, and you know that's going to be $1,000 there, right? So doing it, you know, old school way, right? In addition, though, we could find this and we would say, all right, we've got this particular bond. It's got a payment of $100. It has future value of $1,000, right? So those attributes are going to stay consistent for us. It's going to be N of 1 year. And I of 10%. So if you put that all into your financial calculator there, it's going to give you back the exact same result, right? It's going to tell you that the price is $1,000. So 100 for your payment, 1,000 for the future value, 1 for N, 10 for I, compute PV, and it's come back and tell you $1,000 for that. So now all we're going to look at is what happens under different required returns, right? So at a 5% required return, you just put in 5 for N, compute PV, it's going to give you $1,048 for the price on that, right? Lower required return, higher price. The risk that we're worried about, though, is the price falling as interest rates rise. So you put in there 15% then for your required return or yield, and you ask for the price, you get $9.56. Y'all keeping up, practicing on that? I mean, it's much easier to, I mean, either hopefully you're down on this, right? So then it all, you know, you can go back and replicate it yourself. Just trying to use some chances to practice on that, okay? So that's what we have for the 1 year bond. Now let's see what happens with the 10-year bond. Now, the 10-year bond, right, you can't do it in a simple little calculation like this, but we know how to do it vis-a-vis the financial calculator. One thing that you're going to remember is that based on that $100 payment, $1,000 future value, and 10% I, you don't need to know how many years it is to come back and tell you the price is going to be $1,000. Right? It just doesn't matter because the coupon rate and the required return are exactly the same. Right? But let's go ahead and get the 10 in there because now the impact on the present value, the discounting of those future cash flows is different now for the longer term bond. So now I'll put in 10 for N on the financial calculator. Everything else should be set up, right? If I go for 10 for I, compute PV, it'll come back as 1,000. You can see what happens if the interest rate goes down, but if the interest rate goes up to 15%, so put in 15 for I, find that present value, and it goes down to $749 there. a big movement in that price on the longer term bond. That's the key ingredient here, right? The short-term bond, the price doesn't fluctuate that much. For the long-term bond, the price fluctuates a whole lot based on changes in interest rates. As a result then, the longer-term bonds are going to have a higher interest rate risk. What that implies for those bonds then is they're going to have a higher or greater maturity risk premium, right? Because investors are going to know that, right? Investors are going to be concerned about that issue that you're getting a longer term bond and that interest rates might rise, and so they're going to require a higher return on the longer term bond, right? I want to get some additional compensation for that. I have a higher maturity risk premium or additional return I want to get for that longer term bond compared to a similar shorter term bond. And they show the percentage changes here on this, right? So I'll just do the 10-year bond there where we have the drop in the price. Right? In that case, the percentage change in that is, well, we have the ending value, whoops, the new price is the 749 based off of the $1,000 beginning price, and that's then where we get a 25.1% drop in the value of that bond there. And they got a little graph for us if that's how we want to remember things, right? It's a little bit too simple for me to be really helpful, right? That's just getting really simple there, right? All right, so now we've established that for longer term bonds that the maturity risk premium is greater for those. However, we also have another risk, and that's called the reinvestment rate risk. And the reinvestment rate risk is associated with what is going to happen when you get your money back and you're looking to reinvest it, right? Where are you going to be able to put that money? Well, in this case, it's the shorter securities that have greater risk then, right? Because when you invest, let's say, in a long-term bond for, it's got a 10% yield to maturity, if you hold it all the way to maturity, you're going to get your 10% per year out of it, if it doesn't default, right? Okay, so you've locked that in. So your reinvestment rate risk is low and it's pushed way away from you, right? However, with a short term or a 1-year bond, you invest at 10%, interest rates go down to 8%, you have to reinvest at 8%, they go down the next year, you do another 1 year, it's down to 7%, you're getting lower and lower returns on what was a otherwise lower risk investment, right? Shorter term would have lower risk otherwise, except for the reinvestment rate risk, okay? So those two things offset each other somewhat, right? It depends on your personal investment horizon, et cetera, right? We know that shorter term has less risk, we'd say nominally, but the reinvestment rate risk there is higher, right? Because you don't know what you're going to be able to do with the money once you put it back in, right? So let's say you won $500,000 playing the lottery, you invest the money, you want to live off the interest, you buy a 1-year bond with a 10% yield, well, you're going to get $50,000 that year, right? You'll have $50,000 to live off of. Problem is, the next year, interest rates fall 3%, you're only going to get 15 grand out of that, right? Because you still got your principal of the 500,000 there, and that reinvestment rate risk starts to hurt you then when you use the short-term securities there. If you bought 30-year bonds, I just put that. 30-year bonds, you would receive the same $50,000 each year out of it. Okay, so key ingredient then for our maturity risk premium. Longer term bonds have higher interest rate risk, but lower reinvestment rate risk. In total though, the maturity risk premium is higher for the longer term bonds, right? In total it comes together, and that is the thing that you are most concerned about. So, right, we see this in the higher yield than on longer term bonds, right? They have that risk is reflected in the required returns on those. So where do we see this? Well, we've got ways to map this out so we can see these different interest rates that are available out there in the marketplace, and associated with these then would be looking at the Treasury yield curve is one we tend to look at, because then it gets default risk out of the way completely, right? Just says let's not worry about that. Now, the maturity risk premium though for the Treasury bonds differ from a short-term one to a long-term one, okay? The default risk and the liquidity premium we say are negligible there. So we graph these out into something that we call a Treasury yield curve. The good thing from this graph is it helps us to identify that we tend to think that real risk-free rate is pretty well constant, maybe somewhere between 2 to 3% over the long haul. We've got our inflation premiums. They can actually differ, right, a little bit versus short-term to the long-term. And then we got our maturity risk premiums that build on top of that. So there would be a lot of retirees that would be thrilled to see that available to them, right, where they could invest at those sorts of rates. You know, you can go back to the 1970s, and there was a time when people were able to invest into government securities, right, that were paying, 15% for a long time. Those are all gone now, right, because 30 years was the longest maturity on those, right? So the folks who were getting those all came to maturity, and if they're still alive, right, I hate to put it that way, right, but if those folks are still looking to reinvest that money, they were earning those 14, 15% rates, and then they went to their financial advisor and said, what do I do? And they said, it's not there anymore. We can't do that anymore. Some of those folks had to adjust their lifestyles because of that, right? Now they were lucky that they were to be in that for a long time with those high rates that were not, available to most people over time, right? Over time, those types of risk-free investments are not available. Okay? So let's take a quick look then here at what we've got going on right now. I tried to pull up the Bloomberg charts there, and they weren't charting out for me too well here. So what we can see here then is we got our Treasury yields here in the blue, and 1 month Treasury, if you lend the money to the U.S. government for 1 month rates, you're getting almost zero. It's like 0.07%. Okay, so it's almost more utilized for transactional purposes now for folks that just having to move money into cash from other places they might be looking to utilize it just for the short run. They've got to have that. They can turn it into cash very quickly from the Treasury securities. And you can see how these rates are extremely low all the way out to 1 year, and then they start to pick up a little bit, and we get out to the 30-year, and they're at about 3.27%, I think it is, at the 30-year. Also, you can see then the TIPS real yields here are very low. In fact, they're negative in the 5-year range. So essentially what that says is, since the interest rates are so low as it is on the treasuries, if you want to pay extra to get a bond that has protection against inflation, right? You say you've got 2 treasuries that are the same except one is protected against inflation, you would pay extra for that, right? It turns out that people are paying so much extra right now for that their expected yield on that, the expected yield is negative. However, they're protected if inflation does kick into gear, right? So they're willing to give up a little bit of return, right, for a nice payoff, we might say, if we do have inflation. Okay? Another way to protect yourself against inflation generally is investing in the stock market, though. But you've got all sorts of risk there, right? But generally, stock markets do move up along with inflation. Of course, I said generally, right? I didn't say always. And that's the kicker when it comes to investing. So that's what it looks like there. The actual rates, those are a day old there from that source right there. For some reason it's not wanting to chart up for me here. 30 years are at 3.48%, 10 years at 2.65%. So you have to lock your money up for 30 years to be promised a 3.5% rate of return. You know, for folks who've been in bonds, it's been pretty painful for them in regards to watching the folks who had their money over in the equity markets the last few years, right? Averaging, well, since 2009, it's well more than doubled, right? Since 2009, the equity markets have on average. So, and then the tips here, you can see how there's that 5-year. It's showing a negative 0.4 right there. Right? So people are willing to pay that extra, hurting their expected return. Excuse me, to get that protection against inflation. Then. All right, so we've got about 40 minutes. We have almost a full class period still to go. Amazing how 2 hours and 15 minutes goes, right? So what I wanted to do is, I just printed out a big set of time value of money notes here, and time value work, just to make sure we do a review on this, right? Because we really think that it's one of the most important skills that we need to emphasize then for our finance majors is the not just the ability to do these things maybe on a computer or on a financial calculator, which is part of it, but hopefully really understanding what's going on, right? I think that's terribly important for us. Trying to get out of this program here, right? We'll try to get out of it. So, just 1 second, let me get that set up. Oh, that's the wrong one. That'll be coming your way. Don't worry. So some of this I'm not going to belabor in that you can read for yourselves, right? So like I said, this is just a review, but I just want to remind you then that your time value of money tools are important in corporate decision making. They're important in investment decision making. So it's really important. It's used in marketing decisions, operations management strategy. And of course, a lot of us look to use it then in personal finance decisions. So in my house, I built myself a big old spreadsheet that tracks a couple of things. It's got my expected income, right, going into that over the future. In addition to that, I track it to my updating portfolio values and all my retirement accounts also. And I have set up in there and I'll go in there and I can say, well, what if I retire at 65? And I put that number in, and it kicks back out to me and it says you would be able to expect to survive until age 102, right? Based on your finances there. And I say, oh, okay, that's pretty good, right? I'll tell you one thing I haven't done with this, and it's not because I'm extreme skeptic, but I have not put my Social Security money into that, right? The reason is because there's uncertainty as to whether I'm going to get, 100% of that. I mean, for you guys, I'm just not sure exactly how well Social Security will be funded at that point for you guys. And so with that uncertainty, I'm just one of those, I say, well, I better take care of myself, right? And so I just decided that if I do get Social Security, whatever I do get from Social Security, that'll be the really fun money then, right? I mean, that'll it's kind of weird, right? We're told that we're supposed to get Social Security as like the safety net, right? That's what makes sure, you're not going to starve or whatever, right? But any uncertainty to that, and all of a sudden, I flip the way that I'm looking at it, right? Because I don't know how much that insurance is. I have to take care of the certainty part, right? I have to take care of that with my investments, and then if I get Social Security, awesome, right? That'll be some extra money for me to get by on. So that's one of the things, when we're told something is risk-free, nothing truly is risk-free, right? Nothing truly is risk-free. Even all that discussion I made about all those U.S. Treasury securities there, right? Somewhere there's risk looming. I think they'll all get paid out on. I think I'll get really close to my full Social Security that I was promised, but I don't know that for sure, right? So, anyways, these tools are really important. So, time value of money. Here I just go through a quick example that says if you tell somebody that they lend you 100, you'll pay them 110 next year. That's a 10% rate of return. We can see how this comes together. Next page then, let's say it's going to be 2 years. Most important thing here with the compounding process is we need to see that you get not only 10% interest on the original 100, but you get 10% interest on the original 100 and on the $110 then, right? So, or we might put it this way, that you get interest on the principal amount and the interest earned, right? And that's one of the most important ideas of compounding. Albert Einstein referred to compound interest as the one of the 8 great mathematical results of all time, right? He said he saw its importance at that level, right? Another thing, of course, is people that understand compound interest can put it to use for themselves. Those that don't understand it pay the price, right, of the compound, right? So you want to be on the right side of understanding how compounding works because it essentially builds up on things, right? The costs grow or the gains grow. You want to be on the right side of that one, right? You want to be on the gain side of that interest compounding, okay? So sometimes on the financial calculator you want to raise things to a power, right? So it's going to be the y to the x key or the caret key to achieve that. And then here's our future value calculation, right? So future value then would tell us this. Let's take an example here, right? You're going to invest $1,000 at a 5% compounded interest over 8 years. That number then, the 1.05 raised to the 8th power, that is the future value interest factor. And so these numbers are tabulated. We don't use the tables very often in here. Not in this class, you're kind of beyond it. But there's sometimes that they're a good tool to have as a little backup. So if you ever need to use the future value tables, you would see here that if we go to 5% over 8 years, it gives you that factor back, the 1.4775. Within the financial calculator, sometimes we treat it as a black box, right? And we can make some mistakes if we don't quite understand what's going on. The point is this. Right here, if you invest $1,000, the 5% at the 8 years is what is factoring that up to the ending amount, right? It is a separate calculation from the $1,000. Right? It is the factor that you then apply to whatever the initial amount is. Okay? And that's really important for some of our calculation work here. Now, of course, this one, you guys all know how to do that on the financial calculator, but here's how we do it longhand. Once we start doing compounding in some work, we prefer to do it this way because the mechanics make sense. 1.05 raised to the 8th gives you the 1.47746 as the factor, then times whatever the initial amount that you invested, right? In this case, it happened to be 1,000, and that's how you see that you end up with 1477.46. On the financial calculator, I is 5, N is 8, 0 for payment there, PV is minus 1,000, and you get your future value of 1477.46. Are we all good with that, or was I too quick with that? Are we all following the financial calculator working that? Okay, good. So, next up then. Let's look at many of these in terms of different types of compounding. And we can compound these items either annually, which is the example we had there, or we could do it semi-annually, quarterly, or monthly. So with the bonds, we already looked at the idea of semi-annual compounding, but we could do quarterly and monthly also. Key ingredient here then is we adjust for the number of compounding periods per year. Capital N in this future value formula then would reflect the number of years times the number of compounding periods per year. The capital R here would be the interest rate per year divided by the number of compounding periods per year. So let's take that example previously, and we had 12, this is switched around here actually, 12 compounding periods per year times 8 years gives us 96 for N. The R that we use then is a periodic R. We take the 5% annual rate divided by 12, gives us 0.4167% per month. If we're going to do that one long-handed right here, right, it's going to be 1.004167. When you do that sort of work, you would take the 0.05 divided by 12. You do that first. You start inside the parentheses and then blow yourself out from there. Generally is the most efficient way with the calculations. So I'll take the 0.05 divided by 12 plus 1 gives us this. Raise that, so y to the x to the 96, and we get our factor here, right? That 1.49059 is greater than 1.477 that we have for the annual compounding. Everything else is the same, but the monthly compounding, you're going to end up with more money out of that at the end of the day. So we put that in here, times 1,000, and we end up with 1490.59. Financial calculator, you can roll through these things really quickly, right? So the different rates and the different number of compounding periods there, load those up. The end result here we've got then is we want to show that for the same interest rate per year and the same beginning dollar amount, with more compounding per year, you end up with more money. So everything looks the same, it'd be stated out the same except for the compounding periods on it, and you're going to end up with more money from the one with the monthly compounding than the annual compounding. Of course, we're interested in present value also. That's generally what we do in corporate finance. We want to find how much we should be willing to pay for something right now. And so in that regard, we're generally finding the present value. The present value formula is just the inverse of the future value formula, right? So we just take the formula we had for the future value and we solve it back out for the PV here, right? And a couple of things in this that I want to point out is we tend to prefer to look at it as the future value divided by 1 plus r to the n, because that really highlights to us the idea that bigger required returns in the denominator are going to shrink that present value, right? It just gives us kind of that visual take on it. However, we do have present value interest factors that are available. That's what we calculate out. It would be the 1 over the 1 plus r to the n. Those numbers are also tabulated sometimes, right? And so we've got these tables, and from this, right, we've got those tabulated numbers. A couple of things you want to note for a present value factor is they're all 1 or less, right? That's the discounting that's going on, right? That's the reduction in value that you see from finding the present value of some future amount. And so the present value calculation and all the factors in the table then reflect that. All right, so example here then. You inherit $1 million, money's going to be held in trust for 5 years. You've got a 12% required return on this. So the calculation then to find that present value is you take the $1 million, divide by 1, plus the interest rate, raised to the number of periods on this, or the number of years in this particular example. In this case, your present value interest factor is the inverse of the 1.12 raised to the 5th power there. So you get the 1.12 to the 5th, and it gives you this number in the denominator. At this point, that number really doesn't have a name. It has a name once you take the inverse of that, and you get 0.567422686. Right? So that number right there, which is what you would multiply by the ending amount of $1 million there, is what is doing the discounting for it. That is the present value interest factor. And you end up with about half the $1 million then, is that's what you have in that example there. Now we can also solve for, right, instead of the present value and the future value, we can use these tools to solve for the interest rates or the number of periods that are involved. I know you guys use the financial calculators a lot, but I can assure you in investments class, markets and institutions, that you're going to run across something that you want to do it, you want to be able to do it manually, right? That the financial calculator, black box, just doesn't make sense so much, right? So you want to be familiar with using the formulas also. And that's my sermon for the day, right there. Right? You want to be comfortable with these things. So, for instance, we want to look at solving for R, right? And if we recall that we can get the future value by taking the present value times 1 plus r to the nth, you're just algebraically solving out for r here to get this solution, right? Future value divided by the present value, right there. I have to raise that to the 1 over n power minus the 1, and that's going to give you r. Couple things we want to think about when you're doing this is the following, right? This number right here, you're taking the ending number on the timeline, dividing it by the beginning number, what you invested on the timeline. That ratio right there gives you 1 plus your total holding period return. Right? Does that make good sense? Right? Because all you would need to do to take and find out what the ending amount is, you take the amount that you invested here times 1 plus your total return over the whole time frame. Right? And so that ratio right there of the ending amount divided by the beginning amount, it holds a lot of information right there. Raising to the 1 over n power then takes this, let's say, 3-year example in this case, right? And you would have 1 plus a 3-year rate of return here, raising to the 1/3 power then annualizes it, right? It shrinks it down into 1/3 of that, in other words, down to 1-year rates for you. Okay, so that's what this formula is doing for us, right? And so the example then that we have here, let's say you invested $60 and the stock went up to $79.86 over 3 years. What is the implied discount rate or the annualized rate of return here? Right. Kick that out. 79.86 over 60 to the 1/3 minus 1 comes back and it'll give you 10%. Key ingredient here then is right there inside of this, right, the 79.86 over 60, that actually gives you essentially a factor of 1.331. In other words, $60 grew by 33.1% in total to achieve $79.86. We take that, we raise that to the 1/n power, that 1.331%, and that's what shrinks it back down then into an annualized rate. Do not make the mistake, right, of taking that 33.1 and dividing by 3, right, and saying it's 11% or so, right? These are all the things. That's why I want to work on the formulas here for us, right? Because you get an understanding of this, you're going to be in much better shape and avoid some errors that can be made on things you might think you can just divide and the like when you have to deal with the compounding, right? It really becomes important for us. There have been financial planners that have faced lawsuits because of misinterpretation of averages versus geometric averages associated with compounding. Think about it this way. They had clients that would come in and they sat down and said, okay, if we invest your money here, we can use these average rates of return from the marketplace. We'll put those in and we'll blow this out until a retirement date for you, and you should have this much to retire on. Folks walk away, come back about retirement time, and they discover there's not all that money there. And I'm like, well, what's the problem? You invested the money, these were the average annual rates of return, and what's going on? Well, when they use the average rate of return, they use the arithmetic average numbers over time. Arithmetic averages are always higher than the geometric averages. A geometric average, like this 10% here, right? The arithmetic average might be 11%, right? If you put that into your optimization models, right? If you put the 11% into a model that is going to assume compounding then over all those years, you're going to tell people they're going to be a lot richer than they actually will be because the geometric average rate that they need to have in there is 10% into that model. Okay? So that's what we want to know this stuff, right? It's really important for you as you manage your own investments and advise other people on this stuff. All right. Of course, in this case, one way we could look at this would say, you know, I invested here. There was another stock that actually did better. What was my mistake in my evaluation of this one? So you could say, I should have gotten 12% out of this. So you identify from this process by backing out from here and you say, I was willing to pay $60 for this stock. I should have only been willing to pay $56.84 3 years ago. Now I can go back and assess what I did 3 years ago. Why did I make that mistake, right? What was my mistake in being willing to pay $60 when I should have only been willing to pay $56.84 for this stock, right? So that's one way to back this out and put those numbers to use. All right, you can also solve for n. I could derive that for you also, but I'm not going to waste our time because now it's getting to a point where, you know, the financial calculator is just so much more efficient for this than doing it longhand. But let's take a look at this real quick. Let's go with the financial calculator here and say that we want to invest $1,000. We're told it's going to grow to $2,000 over some period into something that's growing at 8%. Remember this, right? You are always, unless somebody says, jumps up and down and points it out, you're always given the annual rate. Okay? So it's the 8% is the annual rate, although it says compounded semi-annually. Okay? So you're given the annual rate there. So, how do we find the amount of time it takes for this to grow? Well, financial calculator, you'll say I invest $1,000 minus 1,000 is the present value. 2,000 as the future value. The semi-annual rate is 8 divided by 2. Okay. So 4% per period, 0 payments in the middle, and we ask it to compute out then n for the number of periods here. So when that comes back at 7.673, that's going to be an answer that would be given to you on a multiple choice, and it would say 17.673 years, and would that be the correct answer?
Not if it's for annual.
That's right. See, that's the kicker here. You got to keep track. Since it's semi-annual here, that's 17.67 semi-annual periods. Got to divide it in 2, right? Got to cut that in half then to come back with about 8.83 years for that to double. Also on this, another thing to get a feel for the math on it is the following. If you did this exact same problem and you just grew it from investing $1 and growing to $2, it's all the same, right? So you want to get that feel for the calculations as these are factoring processes, right? How does it double essentially as opposed to going from 1,000 to 2,000 or $1 to $2? All right, effective annual percentage rates. We need to review these. You know, I guess part of the scary thing with these is you don't see them a whole lot. And then I think all of a sudden you get back into your 438 class, and the professor expects you to remember it from 331. So we'll take a quick look at them again right here. We want to find an effective annual rate. The main point here is you want to be able to compare, take apples and oranges and turn them both into orange juice, right? You want to turn them into the same thing, right? And so the key ingredient here then is we look at a stated nominal rate with different types of compounding, and then we identify effectively what the rate would be if it were just an annual compounding on that. Okay? It's effective annual rate of return if we're stated as an annual compounding rate. And so here's the formula for it, right? What's the idea here? Well, it's kind of straightforward what's happening, right? If you take a look right there, that nominal annual rate divided by the number of compounding periods per year, that essentially gives you your rate per period. Right? The periodic rate. Okay? Or in terms of the notation I'm using here, right? Just the capital R, right? The rate that we put into our calculator there, right? Okay? By then raising to the number of compounding periods in a year, we take, for instance, this monthly rate, and if we add 1 to it, raise it to the 12th power, then we've compounded it out over a full year. And so now it's going to be effectively what that earns for you over a year based on the compounding being monthly and a monthly periodic rate put in there, and it grows it out for you out over a full year. And that's how we get the idea of the EAR, effective annual rate. So So, you got two examples here then. Would you like to get 9.7% compounded annually or 9.5% compounded quarterly? First thing is, the 9.75% compounded annually, that is the EAR for that. Okay, it's already done for you. But to get it for the quarterly compounding, you need to work that over a little bit, right? So the 9.5% tells you that the periodic rate, in that case, is 2.375%. Right? So the 0.095 divided by 4 is 0.02375. Then you add the 1 to that and raise it to the 4th power to compound it out over a full year. Take the 1 back out and you see then that for investment purposes, you take the investment that says you're going to get 9.5% with quarterly compounding and you do better than the one that was going to pay you 9.75%. Okay, and so that's why the issue of compounding, needs to be addressed. So what the EAR does for you is it shows you that right off the bat. Okay, it takes care of that. So then down here, if you're investing, you want the one with the higher EAR, so the quarterly compounded one, and if you are borrowing, of course, you want to go with one with the lower equivalent annual rate, effective annual rate here. And then it gives you just a couple of examples that show that the ending dollar amount is higher for the one with the quarterly compounding in this case. Right? That's the key, the kicker on this one then. All right, then here, this page, I'm not going to belabor that point here. If you want to dig into that, you are invited to. So the next thing that we need to look at are multiple cash flows and how we get our results from that. One reason it's real important to go through this and kind of labor through this a little bit is that, most of your representations in the textbook and the like are going to do it in the traditional fashion here. They're going to show that. From your perspective, you might be slapping these things in the financial calculator, and that's all fine and dandy. That's good, but the way it's going to be represented to you is like this. So in this example, you've got cash flows you're expecting to get in from your ice cream stand in year 1, 2, 3, 4, and 5 there. You had a 12% required return. So you want to find the present value of that. Our generic present value calculation is you take each of those cash flows and discount them back at the required return for the number of periods. So mathematically, that's how they're all going to look, just like that. Okay? Here we work through step by step, showing the discounting process on each one of those. Right here, for the first one, the 4761, that's the present value factor for that one, is the 0.89857. For the next one, it's 0.79719, so on and so forth. So we've got those discounting factors there, and this is then how we end up with our 21,152.66 present value of those future cash flows. Let's go ahead and hit this, though, real quickly then with the financial calculator so we can see how fast we can go through these. Also, you might want to get familiar, although I don't emphasize it a whole lot, but we'll do it here, using the cash flow function also on your financial calculator. So we want to get that set up. So first thing you want to know is, right, if you don't want to go to the trouble going into the cash flow function, we can do this as follows. We've got our future values, we've got N, we've got I, we've got payment, and then we can find each of those present values. So the 4761 is getting discounted back for 1 year at 12%. The 6312 is coming back for 2 years at 12%. And I hope I'm not running out of room here quite yet. The 7863, the 6312, and then the 3986 that, getting discounted back for 2, 3, 4, and 5 years respectively at the 12 and 0 payments in the middle there. So what I just want to show you is once you get the financial calculator rolling on this, it goes really fast, okay? All right, so put in your 4761, future value. This calculator's not working there. $47.61. Let me try this one. $47.61 as your future value. 0 for the payment, 12 for I, 1 for N, and you compute out the PV there. So that gives you the 4250.89 right there. Once you got the 12% in there, I mean, you just can roll through these. 6312, discounting that for 2 years as N, compute PV, there's your next 5,031.89 there. The 7863, future value, 3 is N, compute that PV, 5596.73. The next 6312, discounted back for 4 years, is the 4,011.39. And then finally the 3986, discounting back for N of 5 years, compute PV 2261.76. So with the financial calculator, right, you can knock this stuff out really quickly, right? Since I've got 4 minutes here then, I'll just go ahead and take this and do it with the cash flow functions also, because I don't know if everyone has been exposed to using those, right? So it depends on who you had in FINC-332 essentially, whether they did that. I don't like to do it in 331. I want people to focus on, you know, the comprehension first. Others just want to jump to it there, right? So what we've got going on here is we have a cash flow feature that allows us to put that all in there. Now I need to clear that out, so let me see. You can hit second and then clear work there and get that down to those items being cleared out for you there. So hit cash flow and then second and the clear button, and you should have a registry that's all clear here. We don't have any cash flow at year 0 in this case, right? Because it's starting off of the year 1 cash flow you can get back from this. Let's go ahead and then arrow this down. So you see the down arrow, and you want to put in the 4761 for that first cash flow. Hit enter, arrow down. It's going to ask you for the frequency on that. It's at 1, so you can go with it, right? It's going to happen 1 time is what it's telling you. So you could enter that or just let it sit there, and you move yourself down to the second cash flow. You want to enter the 6312. In this case, enter that, arrow down. You can see it has a frequency of 1. We're good with that. Put in your 7863, where it says C3, enter that, arrow down, frequency of 1. Do your 6312 for the cash flow 4. 2 arrows down, put in your 3986, enter that, and you have all your cash flows in there now. We're all ready for us to move forward then? I'll arrow down twice. Okay. All right, and we can go all the way back to the beginning there. Now we want to calculate out the NPV. So you just hit NPV, and it's going to ask you what is the required return that you've got on this. What is the discount rate? So you just hit the NPV button. You should hit 12, enter that in, arrow down, it'll say NPV, and now you just tell it to compute that for you. And that is now taking care of all those cash flows for you, and is giving you back the present value, in this case, of those cash flows. The NPV is the same because there was no initial investment at this point where we were analyzing it there. So the 21,152.66. Let's say, for example, that you had invested 20,000 in this, because generally that's how we would think about it. Go ahead and hit your CF once again, and just put in 20,000. Change the sign, enter that in for your initial cash flow, and now let's ask it once again for the NPV, so just hit NPV, the I is good, arrow down, ask it to compute, and right, we can see that it gives us that updated result there then, gives us the net present value there of 1,152.66. All right, so I know some of you were maybe trying to use other calculators. If you were and had any trouble with that, I'd be happy to help out, so just let me know. Anybody, we want to get really good with our calculators here, so if you've got any questions on using those, just let me know, okay? All right, you've got a weekend. Get some more questions, some more problems posted up online. I think I'll shoot you some time value questions also that I want you to hand in, that you work out to, and instead of doing them online, that you hand in to me, because that's a good practice for you, okay? So I'll give you a few little time value problems also to hand in on Monday, all right? Have yourselves a great 4th. See you on Monday.
Yeah, that could be, just have a little calculation problem.
Sure enough, just.
Yeah.
And you're working with the TI-84?
Yeah. Obviously, I think
Long
I would say we would do it this way.
Yeah. Cash flow.
Yeah,
Yeah. Bear with me, I'm probably gonna make a mistake here, because I don't use it that much, so where's your finance? It's good. Cool, very good. So, the NPV one?
No, I know how to add the cash flows in, but I don't know if we're interested in the uses.
I think in this, we just give it the, right there.
Right, sorry.
Okay, good. Then you put in the initial investment. Well, I'll do it with the 20,000, okay? And you open up a new parentheses.
Open a bracket.
Or a bracket, huh? There we go. And then what are the numbers then? Go ahead and.
All right.
Go ahead and put those in. I think this is gonna get it. And if not, it's a little nuanced, so we'll check, right?
I had a quick question. What was the HPR? What did that represent?
Holding period return,
And that was just equal to the future value divided by the present value?
present value, right? So that's your total return, 1 plus the total return of 33.1% that you get over the full 3 years.
So that's just that, and not the 1/n isn't included in that?
That's right, the 1/n is not included. So the 1/n then is what takes that 33% and shrinks it down to a per year basis for you. Did that work?
Hold on.
Okay.
Sorry.
Oh, that's good.
Got a different number.
Not get 1,100 something?
No, I got 9,995.
Maybe it maybe it's not 0.12, maybe it's 12 in there.
12?
Yeah.
Okay.
Go to the bathroom real quick here.
Yes, I got that correct. Yeah, should work.
Hold on a second.
Yes, yes.
20. We're going.
You're done. Pretty good.
Zero.
Oh, no, it's not gonna be 0 for that first one, the little? No, it'll be 30, it'll be 4761.
Oh,
Yeah, see, that is, see, I'm putting in the